Good morning, everyone.
Good morning, Spence.
It's just a little bit after 10 a.m. We're going to give just a couple more minutes for some more people to log on here. I do see attendees joining at rapid speed, so we're just going to give it a couple more minutes until we get a few more people logged on here, and then we're going to start. So if everybody could just hang tight for a minute, we will get started momentarily.
Where are you broadcasting from, Phil?
I am in Grand Bend today.
Oh, nice.
Oh, awesome.
Yeah, I just made a long weekend of it, and right after we're done, heading back to Toronto, I'm afraid. But it was lovely.
Oh, nice. It's beautiful country up there.
Yeah. Yep, lots of greenery.
Yes, yes, for sure.
And it's actually are you guys open like patios and things like that? Or are you in one of these still like Toronto?
We're not Toronto, but we're getting there. By Friday, we'll have a lot more things open.
Okay. Yeah, Grand Bend is closed, but if you go to Godrich, it's open. So there's a dividing line between, 10 minutes up the road, and the patios were open, and kind of spread out, but it was nice.
That's going to be exciting.
Yeah.
Nice to see back to somewhat normal.
Exactly. The new normal.
The new normal.
Wonder what that will look like in months. Who knows,
Yeah, that's a good question. People are amazingly adaptable. That's one thing I know.
Yeah, I think we've done pretty well, actually.
Me too. Well, you guys have done amazingly well. I mean, You're selling a lot of real estate.
Demand's pretty high still.
Well, and I think it's just because you're awesome.
Well, of course. We got 70 on so far. That's good. Wow.
Wow, very impressive.
Yeah.
Why don't we, Spencer, why don't you kind of kick it?
Okay, so people are probably going to keep trickling in, but we want to stay true to time here this morning. We have a lot of content to get to, so we are going to get started. It's a little past 10 here. It's very strange not being able to see everybody. I just assume everybody can see me. Everybody's logged in, comfy from their couches in their PJs this morning. So again, good morning. For those of you who don't know me, I am Spencer, the team's administrative coordinator. I recently just returned from maternity leave. Last year, I became a mama to a beautiful baby girl named Rebel, and she 1,000,000% lives up to her name. So I'm very excited to be back in the swing of things. It was a wonderful year, but I'm ready to be back to work. I'm excited to be back, and the team is very excited to be hosting our first virtual class this morning. So as most of you know, advising in real estate investment has made up a large part of our business, and we have been speaking to a similar form for many years now. And based on the names that I saw register, I know that quite a few of you have attended our in-house classes in the past, but thanks to the beauty of technology, this is our first virtual class this morning. So we hope that you enjoy, and we have a lot of great content. We really hope that you find it enjoyable and informative. We have an absolutely amazing guest speaker this morning. We are so grateful and humbled that he's joining us. It is Phil Soper. He is the president and CEO of LePage Canada. Phil is an industry visionary who absolutely embraces innovation and whose just passion and enthusiasm is infectious to be around. So Phil is going to be addressing the state of the Canadian real estate market and sort of what new trends we're seeing emerge in the wake of COVID-19. And for those of you who haven't had the pleasure of meeting the entire team, I'm sure you've seen them over the years in our marketing and whatnot. I'm just gonna have everybody on the team say hello. Shauna Connolly, if you wanted to say hi.
Hello, everybody. It's so nice to see some familiar names here. I'm so glad you can make it. Thanks for joining us virtually. We're very excited to have you.
Awesome. Andrew Gago.
Good morning. Thank you for taking the time today to join us for our webinar here. Yep, very good.
Nicole Lanigan.
Hello. Thank you for joining. Such a pleasure to see you guys.
Awesome. And Sue Aiken, our sales partner, Sue.
Good morning, everybody. Thanks for joining us. This will be really fun. Lots of stuff to learn, and markets in general and everything. So I think it'll be a really good session.
We actually wanted to make a quick special shout out to our sales partner, Sue. Sue has been our absolute unsung hero during these just unprecedented times. As many of you may have been the recipients of one of Sue's masks. Sue, one of her favorite pastimes is sewing, and she is just very passionate about our clients and our communities, and she worked just tirelessly in March and April. She sewed her little butt off. She made over 800 masks for our clients, our friends, our families, and neighbors. And in lieu of payment, she asked instead that donations be made to the Royal LePage Shelter Foundation. And for those of you that don't know what the Shelter Foundation is, the Royal LePage Shelter Foundation is Canada's largest public foundation dedicated exclusively to funding women's shelters and violence prevention programs. They help women and children escape violence and rebuild their lives. So we don't have exact numbers of what was donated, but we do know that quite a few of you did donate, and we just wanted to take this chance to say thank you very much for doing that. We really appreciate it. And we are just very proud and honored to have Sue as a member of our team. So last but not least, we have our team leader, Mike Heddle. So Mike, if you wanted to say hello.
Good morning, everyone. Thank you for joining us.
I'm going to throw it to Mike in just a second to get us kicked off. I just wanted to really quickly run over our agenda for this morning. So Mike is going to start in just a second. He's going to give us a market update on the current market conditions here in Hamilton and what's driving them. And then our awesome guest speaker, Phil Soper, is going to be addressing the state of Canadian real estate market. And then lastly, we have Shauna Connolly, who is going to be taking us through a couple of case studies with real clients who have taken action during the past couple of months and what sort of results they've been seeing. And then she's going to have an amazing investment opportunity that she's going to present to everybody. So after each speaker, we're going to kind of pause. If there are any questions, we'll try and answer a couple of them. If you do have a question during any of our presenters, you can type it in the bottom chat box bubble there, and we will try our best to answer at least a few of them. And if we don't get to your question, we will reach out directly to you after the fact and get an answer for you. So I think that's everything that I had to say. If I missed anything, Mike, maybe you could touch upon it quickly. But without further ado, I'm gonna let Mike take over.
That was fantastic. Thank you, Spencer. This is a little different for us. It's much easier to see all of your reactions. So I feel like I'm blind going into looking at a screen of myself, which is something I hate to do. So bear with us.
You're looking good, Mike.
Bill could probably agree. So I usually like to start with breaking the ice. I'd ask you to raise your hands, but we're going to try and host a poll. So let's see if I can get this going here. Bear with me. So 2 questions that I'd like to ask to get us started. So hopefully you can all see that poll. How many of you have purchased real estate in the last 0 to 3 months? 3 to 6 months, 6 to 12 months, or the last year, 12 months plus. Let's just kind of get an idea of what our audience looks like. And our numbers are fantastic. We're approaching 100 people to have joined us today, which is amazing. We had about 150 registered. So it sounds like duty called for almost half of you, which we were expecting, but this is a great turnout. So I'll give that another second for everyone to kind of vote if they'd like, or comment if they'd like. And I'm just going to share these results with you guys. So looks like about a quarter of you have purchased in the last 3 months. Wow, that's amazing. About 13% at the 3 to 6 month mark. Another quarter within the last year. So that's awesome. So if many of you are seeing what's going on and out there shopping, which is fantastic, I'm going to just launch the second poll. So how many of you plan on purchasing within the next 0 to 3 months? 3 to 6 months, 6 to 12 months, and 12 months or more. Look at these numbers come in. I'm not sure if you guys can see that. I will share the results with everyone just in case you can't see all of that. This is our first time using Zoom, so bear with us. You guys have been patient. This is fantastic. So I'm going to kind of move us along here. Looks like everybody has logged in there. So interesting, about a quarter plan on purchasing within the next 3 months, and another quarter. So half of you are planning on purchasing real estate within the next 6 months. Isn't that amazing? And I think you're going to kind of see as I get into talking about what's going on in Hamilton, participation is very, very strong. So thank you everyone for participating, for you know, engaging with us. I think this is great. You know, wow, what a year 2020 has been so far. And we're all hearing the term unprecedented, but I don't know how else to give my perspective on what's taken place. I think as we walked into this year, I don't know that any of us imagined how quickly the spread of a virus could impact so many countries and economies and businesses. Families and lives, and certainly as we watch, you know, the way it's being presented from the media, it's a really interesting observation. And I've come to the conclusion I'm seeing what I'll classify as 3 types of people. Observation. There are those people that are watching the numbers, the death tolls. They're sharing all of the negative news out there, and that's how they're responding to kind of some of this media and this doomsday. The second type, which is pretty interesting, I find this in myself, those that are pausing and reflecting and finding great peace in not having to go to work or work as frequently, taking a pause and a break in the regular day-to-day grind. And I'm going to share a story with you that's how that's impacted my life. And then those of us, and you guys just illustrated, half of you are interested in acquiring real estate. Those of us that are doubling down, taking action, seeing opportunity in not only business, but life. Take time to focus on your health. So I'm going to share a quick story with you on how COVID's impacted me and my family. Fortunately, the technology has allowed me to work a little bit more from home. I've got, many of you know, I've got 2 beautiful daughters that I adore. And about a month and a half ago, the 4 of us, my wife and 2 daughters, decided to go get ice cream. And of course, the only thing open was the local corner store. So we went for some ice cream bars. And on the way back, my youngest daughter, who's 6, Heddle, looked at the dash and she said to me, "Daddy, what does that symbol mean on your car?" And she was, of course, referring to one of the icons on my dash. And I replied to her, "Which symbol are you referring to, sweetheart?" To which she answered, "The one of the man that's flying through the air trying to bonk his head on the phone." So I will never look at a USB charging
Exactly.
And I hope you all now look at this symbol and see nothing but of a man flying through the air trying to bonk his head on the phone. And I thought this is interesting. You know, I couldn't help but think of all these signs and symbols and how confusing it must be to a 6-year-old. But whether you're 6 or 26 or 46 or 66, there's a lot of confusing symbols and information out there, and I love starting my market update with this. Recent news articles. Last week, June the 9th, we saw an article that stated the National Bank of Canada forecast the sharpest real estate price decline ever. Look at that photo, the CN Tower embraced in either smoke or fog. It's pretty doomsday, it's pretty negative, it's pretty eerie. And only 3 days later, we had an article, interestingly, the same photo of the CN Tower. The Toronto real estate market is suddenly on fire again. It's confusing. It's confusing if you open the newspapers. And I'm here to provide the facts, share what's happening in our local market. So I'm going to dive into, you know, I like numbers. I'm going to dive into what's happening here in Hamilton, and we're going to report and just share some of the numbers with that are provided by our Hamilton Real Estate Board, Real Estate MLS system. So this May, we saw listings, about 1,550 listings come to market. What does that mean to you guys? It was about 30% lower than we saw a year ago. And that makes sense. We were asked and told to pause and to, you know, not conduct in anything other than an essential service. We saw sales follow that trend. So 850 sales this past May, which represents a 42% decrease over the year before. So again, that makes sense. Everybody was following what we've been, guided to do from the government and the health officials. This is an interesting number. We saw about a 40%, 43.4% increase in April. So we're up from last month. And I love this number. I find this really, really interesting. Our average price in Hamilton, Burlington is $655,418. That's a 10% increase over May of 2019. So although we're seeing these declines and pause and less participation, I'll call it, we're still seeing a rise in average price. And Phil, I know we had a webinar call a little while ago, a month and a half ago, and I say, I don't mean to introduce you here or bring you in here, but I know my question to you is, what do we predict prices to do? And Phil commented on it. So I'll let him comment as we give him the stage here. But this was a big question mark. And for most of you, or all of you that are homeowners, this really is the most important number, or the number that's perceived by the public as what really impacts me, is what's happening with the price of my home. I share this slide. I like to always broadcast and show our biggest movers. Which marketplaces have we seen the largest increases in value? And I've got to say, this is a kind of a first. We're seeing our rural markets, so areas like Dunnville or Caledonia, Dundas, Cayuga, West Lincoln. They've seen the biggest increase in prices, 26%, 24%. You'll notice there's a big decline in volume, and that makes sense with what I was sharing with you all. There's not as many homes being sold, but I don't know how to interpret this data. I find it quite interesting. Does it mean we're seeing people sprawl out of the big cities? The data might suggest that. So big increases in those outlying markets, but even in our core here, Hamilton East, a 13% year-over-year increase in value. So what's happening? I'm going to dive into some more numbers here. Last year in May, as I just kind of went through, we saw 1,400 sales, about 2,200 active listings. Average price was about $595, and our average days on market was 27. So as I've just kind of alluded to, this year we saw a decline in almost all of those numbers. So fewer sales, fewer listings, the days on market increased slightly, but that average price continued to climb. And the number that I'm going to share with you is what I'll refer to as a market intelligence tool. I'm asked this question almost every day of the week. If it's not by the sales partners within the team, it's within the industry or at an open house, or yesterday I was at the bank replacing my bank card, and the teller said to me, "Oh, you're in real estate, how's the market?" And I don't know if you guys realize, I wish I put a poll in here, by a show of hands. How many of you have asked this question, how's the market? What you're ultimately asking when you ask this question is the strength of the market. This question is really to find down into, are we in a balanced market? Are we in a buyer's market? Or are we in a seller's market? And the metric that we often report is months of inventory, or sometimes it's referred to as absorption rate. It's really the supply and demand metric that people are when they're asking the question, how's the market? And you'll see, I'll get into this, there are micro markets within that question. So as our audience, I don't ever want to hear you ask me again the question, how's the market, without predefining. Are we in a seller's market? Are we talking about the luxury home market, etc.? So I'm going to just walk through a quick calculation with you all. I like to kind of give some value. Many of you are investors, and I'd like you to chat with, if it's not us that's representing you, I think you should ask your realtor, this specific question. So in May of 2019, to define this number, this market intelligence tool, we take the active number of listings. It's a very simple calculation. We divide in the number of sales, and that's going to report on the strength of the market. In other words, last year, it would take 1.5 months to sell all of the homes that were on the market, provided no new listings came onto the market, okay? And this year, May 2020, we saw a slight softening in this market. We're sitting at about 1.8 months of inventory. And as I put that into an overlying, what does that mean? Let me define the markets. 0 to 4 is typically, 0 to 4 months of inventory is typically defined as a seller's market, meaning it's good to sell. All the homes on the market should sell within 4 months if there were new properties coming onto the market. And of course, there always is. Between 4 and 6 months, of inventory, which is identified in the blue there, is defined as a balanced market. And then anything over 6 months, which is in the yellow there, would be defined as a buyer's market. And we started tracking this, probably back in about 2015. We started putting it to some of our reports for our sellers or for investors. So I've illustrated here since 2017, how was the market? And you can watch that graph. The lower the graph, the stronger the market. So in 2017, if any of you were in the market, you'll remember it was a runaway market. In fact, in Hamilton, we were running less than 1 month of inventory, meaning every property and more on the market that month sold. And then in about April, the government introduced the Fair Housing Plan, followed up with, in October, the stress test. And I've marked both of those there in red. And look at how those had an impact in terms of, let's call it market strength, right? We saw the market soften a little bit or move towards a balanced market. And then as, economies continue to equalize and reach equilibrium, we saw the market strengthen. And here we were, if I can mark, I don't know if you guys see this, but if I look at March of this year, we were back down to about 1 month of inventory, which is a very, very strong seller's market. And the red line there marks the state of emergency. When the government, froze everything, announced a state of emergency, we saw the market soften, move up towards a balanced market. But look at this last data point from May, we're creeping back down into a stronger seller's market. And I've put these next few slides, not to overwhelm everyone. Some of you will love this numbers. Others will just see a bunch of scattered data points. But really what I want to illustrate in this slide is you've got your macro market, as I showed before, and you've got your sub-markets or your micro markets. So if we look at the district of Hamilton Central over that time frame, we certainly see the market strengthen and weaken with each month. But if we dive down a layer deeper into the sub-markets within that Hamilton West market, you'll see as we go through some of these data points, in fact, some niche or micro markets may fluctuate into a strong buyer's market. And as an investor, or if you're just a seller of your matrimonial home, this is a market strength tool. This tool should tell you, how strong is the market. But if you're an investor looking to perhaps purchase a deal, buy a property that maybe you can get a deal on, and I've said there are no deals out there. You've heard me say this for years. But look at Hamilton West over the last month. 2 of our sub-districts moved into almost 9 or 10 months of inventory, suggesting that it was, in fact, a buyer's market. So that would have been a great opportunity. For those of you, those 21% of you that indicated you did take action, hopefully you took action in those markets where they were a little bit softer and maybe you weren't in such a competitive environment. So we can send all this out. I'm going to wrap up with a little bit of how we're going to send you guys some of this data points. All of those metrics that we typically report on are what I'll refer to as, coining this term lately, a lagging market metric, meaning last month we reported that the average sale price was this, or the average days on market was Y, for example. What we've started to look at during COVID is what I'm going to refer to as our leading market metric. And quite honestly, a lot of this data hasn't been available to us as brokers or salespeople. It's stored from these booking companies. So what I'm illustrating here for you guys is one of the largest booking companies that many brokerages use to arrange their showings. And certainly throughout the sales process, an offer starts with a showing typically. And a showing will turn into an offer, and an offer will turn into a sale. So if you look at this chart here, I'm going to reference the orange line. And the orange line is the data point for showing participation, or the number of showings that took place on properties in the province of Ontario. And you can see it was significantly higher than the year before, 2019. And right around March 15th, a day or two before the government announced a state of emergency, we saw this rapid decline in showing participation. And that makes sense, everything that we've talked about. Buyers were told not to go out, not to look at properties. Sellers were weary to have people in their homes. We saw showings decline about 70% below where they were, normalized versus the first part of the year. And as we reach mid-April, we've seen that metric strongly increase. So much so to that yesterday or Saturday, I pulled the latest data point. On Saturday, we were showing 124% more showings than we saw in the first week of the year. And this to me is illustrating not only the point that I showcased with months of inventory, but this leading metric, there's a lot of participation. And I believe that we've seen fewer listings, and this is kind of creating or feeding into this, I don't want to call it a perfect storm, but with low inventory and high participation, many of our agents are out in competition. We're seeing this very strong market again. So to me, this is one of the tools. If you're a client of mine or ours, we've been giving you weekly updates, as to when to go to market. I think this is a really interesting tool to look at and to utilize, and we'll continue to watch it as we proceed. And what's causing all of this? And I've actually borrowed maybe even this slide to a T from Phil. I'm going to get into this in a moment, but I love listening to Phil. Bringing him on here was selfishly for my interest, but I knew that you all would find great value in what he has to share. So there are a number of driving forces that really impact market values. There's some metrics some magazines or journals will look at as many as 50 or 63 metrics. I boil them down to about 7 factors that drive values. And there's things like net migration. Are more people moving into an area or moving out of an area? Is average income on the rise within a region, or is it declining? Employment rates, are they increasing or decreasing? Mortgage interest rates, and wow, last week we had interest rates of 1.99% posted. I mean, we've never seen borrowing costs so low. We've got the ripple effect, which we certainly experience here in the greater Hamilton area, meaning we're closest to one of Canada's largest mega centers, Toronto, one of the biggest real estate markets in the country, and we're seeing a bit of a ripple effect outside of Toronto. People are driving until they qualify. Of course, provincial and political climates, and then transportation expansion, and certainly along that QEW corridor where we've seen a big investment with the GO has impacted our values in this region. So I'm going to kind of finish on 2 slides before I give Phil the stage here. Usually at this point, I would take us pretty high level, go up about 30,000 feet and talk about the region and some of the country's driving forces. But I'm going to have Phil do that because I believe he is the country's foremost authority to address the state of the nation. This report here, I'm going to show you what's kind of happening in the Golden Horseshoe region. We live in a very unique region, and we're landlocked. We've got Lake Ontario to the south of us and the world's largest greenbelt to the north of us. And we're experiencing in this region what we call the Manhattan effect. There's nowhere else to build but up. This report is pulled from what's called the Municipal Comprehensive Review. And under the Places to Grow Act, every region is required to prepare a review of the growth plan for what's taking place within its municipality. So this is provided from that Municipal Comprehensive Review of the Greater Golden Horseshoe region. And I'm just going to read this word for word because I always find this amazing. This region is home to 9 million people, meaning that 1/4 of Canada's population lives here. It attracts 1 in 3 new immigrants, and by the year 2041, it's forecasted to have a population of 3.5 million people. So 9 million today, in 20 years, we're going to have almost 14 million people. This region is the most important economic region in the country, and it generates 2/3 of Ontario's and 1/4 of Canada's GDP. So Phil's going to address that. I've shared the way that this chart or this comprehensive review has changed over the years. In 2005, you can take a look at the slide there on the left, you see density in the gray area. And by 2017, you can see a lot of that density sprawled out. The light orange areas are areas that there isn't much density in. One group went as far as to forecast what that looks like by the year 2041. They filled in all the purple areas, and you can see we're kind of exploding. We're kind of running out of land. We're bursting outside of that greenbelt region. So Having said that, I guess kind of without further ado, I'm going to hand things over to Phil. I'm going to, before I do that, actually, sorry, let me back up. I missed a slide. I'm going to open up if there are any questions. And before Spencer, before you do ask for those questions, I'd like to just kind of share a little bit. Spencer's going to talk and give kind of a CV of Phil, but I've gotten to know him over the years a little bit. And I'd like to share that I can listen to him speak about real estate or economics or the industry for hours. And I consider myself, Phil, one of your largest fans. But not only am I a fan, I consider you a friend. I've been fortunate enough to try wake surfing with you in Muskoka for the first time. My first dive was with you in Australia on the Great Barrier.
That's right, yeah.
I've toured Rome with him in vintage Fiats and Portugal in vintage Volkswagen vans. To say that I've heard him speak about Canada's real estate market a lot would be an understatement. And every single time I listen to him, he leaves me on the edge of my seat wanting more. So I know you guys are all going to enjoy what he has to share. Spencer, I'm going to open you up to any Q&A before she introduces you, okay? Spencer, did we have any questions come in? Are there any questions that anybody has?
I was muted. No, none so far, actually, that I can see.
Okay. Great, fantastic. We didn't know if anyone watching does have questions, feel free to email us or put them in our comments here. If we don't get to them during our presentation or webinar here, we promise we'll follow up. Okay, Spencer, I'll have you introduce.
Awesome. Thank you. So yeah, as Mike illustrated, we are all just kind of fangirling over our amazing guest speaker, Phil Soper. As I mentioned before, he's the president and CEO of LePage, which is Canada's largest real estate brokerage. Phil has consistently ranked as one of the most influential leaders in Canadian real estate by SP 200. And in 2016, Phil became the first Canadian to receive the Real Estate Leadership Award. Real Estate Marketing Magazine named him one of the top 25 most important leaders in the last 25 years. And we couldn't be more proud to have him as our president and CEO. Again, just to say he's a big deal is a complete understatement, and we're absolutely thrilled to have him join us. He's going to address the state of the Canadian real estate market. So Phil, if you want to take it away, you're on.
Well, what a delightful introduction. Thank you, Spencer. Thank you, Mike. I learned a lot this morning. I was scribbling, taking notes, and I will steal, freely from your insight, Mike, and use it as a further indicator that we're heading in the right direction. Listen, folks, thanks for tuning in today. I will say the Heddle team is one of the most organized and professional real estate advisor teams we have in the country. We are the oldest real estate firm in the country, dating back to 1913, and with property sales of $100 billion in 2019, we're the largest. So to say that about a group of professionals like this, we have thousands and thousands across the country. So congratulations, guys. You deserve all the awards and kudos you get. You do a fabulous job for us. I'm very proud that you've invited me to be here today. So for everybody else on the line, I'll just provide a little bit of insight as to what's going on at a high level. And as Spencer said, type in the chat if you have any questions, and Mike and I will take a crack at them. One of the things I'll say right off the bat is forecasting is always a black art. You take data, we build models, we call them econometric models. They use things like GDP, gross domestic product, what you might call the revenue of a country. We use GDP and employment and interest rates and immigration and a host of other drivers, and we put them in models and we churn away, and it outspits some probable outcomes, and then we apply human experience and intuition. The problem with models these days, and the reason you're seeing forecasts that are all over the map, I've never seen them so divergent, is we've never had an experience where unemployment fell or the GDP fell because the government asked us to shut down the economy. And I believe this is why you see some of the models predicting really drastic falls in the economy's output and, for example, home prices. One of the big outliers in terms of a very negative view on the country is the largest mortgage insurer, which is owned by the federal government, the Canadian Mortgage and Housing Corp. The head of CMHC is retiring very shortly and has, in the course of his last weeks on the job, has taken to Twitter and is leading all sorts of what feel like somewhat crazed assumptions about where the Canadian real estate market is going. So if you want to get a very different view than the one you'll hear from me and from LePage, I'd say look up CMHC on Twitter, because it is important that you see both sides of the equation. I thought it would be useful to start just with a couple of data points on the pandemic itself, the medical crisis that precipitated this unusual economic time. Well, the first thing is we are making progress. Science and medicine is making progress. Here in Ontario, which is the second hardest hit region in the country, we're starting to open things up. We were talking about it on the call before we went live, and little by little things are rolling up. For 8 days in a row now, we've had less than 300 new cases, which is very, very low with a population as high as ours. And in fact, if you go look at new cases dating back to March, you'll see something that resembles a bit of a mountain. It climbs and now it's falling. In many parts of Canada, new cases are down to zero. It really is only Ontario and Quebec that have any significant number of cases. Alberta would be third. The rest of the provinces have almost extinguished the new cases to this extent. There's also treatments that are getting rigorous scientific review, what we call peer review, and are very promising. One released yesterday morning out of the UK, which they studied thousands of patients in a blind, independent study fashion. In other words, they had thousands who weren't on a treatment and thousands who were on a treatment, showed that they could reduce the fatality rate of very ill people by 1/3 with a drug called dexamethasone. I've got a kid in medical school. She'd laugh at me for that pronunciation. It's an inexpensive steroid that's been used to treat other kinds of inflammation in the body, and they've found that it works. I'll compare that to chloroquine, hydrochloroquine, which the President of the United States was touting with no scientific evidence earlier in the year, and which the CDC, the equivalent of Health Canada in the United States, quietly released a statement last week saying, please don't take hydrochloroquine. It doesn't work, doesn't do anything. So we have to be very careful and let our scientists and our medical health professionals steer us down this path and keep politicians out of it to the greatest extent possible. One of the things that Canada has done extremely well in the context of the world is our leaders stepping back and taking advice and counsel from scientists and medical professionals, our public health officials. The IMF, the International Monetary Fund, gave us very high marks in terms of the way we manage the economy in the context of managing the health crisis so far. And you'll see that in the per capita results of our approach, collective approach as a nation to addressing this health emergency relative to other countries like the United States, where there was a lot of infighting among leaders and even questioning in public forums, public health authorities. So progress from science, progress from medicine, and that's eventually how we will completely emerge from this crisis, is we will have cures for a dangerous new disease, which before it appeared, we had no treatments whatsoever. So we've moved very, very quickly around the world, and that's a very positive thing. If we look specifically to the Canadian economy, you'll see numbers reported about devastating unemployment numbers, unprecedented drops in GDP. Let me just put that in context and loop back to what I said earlier in the call. We don't have a precedent where the government said, we'd like you to shut down your business. We'd like you to shut down the economy. Those numbers to us are somewhat irrelevant. The numbers that we see once the economy is open and has been open for a month or so, those numbers will be relevant because we won't be voluntarily shutting down the economy at that stage. It'll be a representative gauge of what the economy is capable of in the wake of this economic crisis. That said, the Bank of Canada and our own internal economic forecasts are trending at above expectations. In other words, we're doing better than we expected when the crisis first hit us in Canada in March. So let me leap into the real estate industry overall in the context of the economy. First thing I'll say, for those of you, and obviously just looking at the bravery and the potential investment profile of the participants on this call. You wouldn't be on this call with the Heddle Group if you weren't very serious about real estate investment, either for yourself personally or as a business person investing in real property. But what was it? 75% of the participants are looking to invest in the next 12 months. That's quite a vote, a testament to the strength of the Canadian real estate market and by extension, the Canadian economy. When we rebuilt our forecast back in March, when we realized after what we saw in Europe that this was going to be nasty, that the government was going to shut down the economy, we had anticipated somewhere between 10 and 15% of transactions nationally would occur in April and May, because we anticipated that the economy, for the most part, would be shut down in April and May. And that is absolutely what happened. For the vast majority of the population, we were under shelter at home restrictions right through those 2 months. And only emergency housing needs were to be addressed. Well, to give you an idea as to how serious those emergency housing needs must have been, even in April, which was the nadir, the very dip, the very bottom of this curve, there was still a full third of transactions occurred. Not 10%, not 15% emergency, like a third, 33%. Even in Quebec, which had the highest rate of infections and was really seriously shut down. In Quebec, you could not walk onto a property. You could not visit a client, even socially distanced and masked in Quebec in April and the beginning of May. Even in Quebec, nearly a third of the transactions of normal compared to a normal rate of transactions went through. So demand for housing in Canada is incredibly strong. And you know this because you have been one of the hottest trading areas, real estate trading areas in Canada for a number of years now. And you know the prevailing concern in your trading area, and in fact, in the major urban areas across the country, was not the health of the Canadian real estate market. It was a housing shortage. We just didn't have enough property to put roofs over the head of the needs of the people out there. And I'll touch on that a little bit more. Mike did a great job of bringing the context in earlier, but I'll loop back to it because it's an important point. But now we've got results for the month of May across the country. They're just released on Monday. And we saw a 57% rise in the month of May over April. So it rose by 57% to an absolutely horrible number. If someone had showed me the numbers for May of 2020 back a year ago and said, this is the number of transactions you're going to see across the country, I'll go, oh my God, that's awful. What happened? Did we have a plague strike the country? Well, in fact, we did. And so even though they rose by 57%, it was one of the lowest Aprils on record in decades. So we're climbing out of a deep, deep hole. But remember, we're already mid-June. Mid-May, there was very little open in the two most populous provinces in the country, which are Quebec and Ontario. We were still under strict lockdown guidelines. So I'm not surprised. Remember what I said, we anticipated somewhere between 10 and 15% of transactions, of normal housing transactions, would go through in May. As it turned out, it was about 60%, 60. So we're trending on the higher end of our outlook for the country. So what about price? And then I'll get into some of the other interesting little backstories to wrap things up today on what we're seeing and where things are projected. But what's happened to price so far? Well, in the early part of the year, my biggest concern was a return to 2015 and 16. We had anticipated a pretty robust year for the Ontario real estate market in particular. And we were concerned. I was personally really concerned that we were headed not just for double-digit home price inflation, but potentially in that 15 to 25% per annum home price inflation, which is horribly concerning to anyone who's looking out for the long-term health of an industry, housing, or an economy. Because remember, real estate is the number one economic segment in Canada, just slightly ahead of energy, oil and gas. So it's a very important part of the Canadian economy. And I was worried about runaway home prices. We came into March in the first quarter of this year with all regions pulling ahead, even Alberta, which has had a really tough time since oil prices fell in 2015, even Alberta was pulling ahead. Everything was looking good. And my big concerns, Vancouver, Toronto, call it golden horseshoe, home price inflation. And then we hit a wall when we were asked to shut down the economy. So home prices did dip in that April timeframe and into May. They didn't dip in the way you might expect though. Anyone who was trading in real estate in April was a risk taker. They were a good metaphor is the people that got into the stock market and were making investments as the markets were plummeting. People that were actually buying. Well, they came in two flavors. One, they desperately needed housing. Say they just moved to the region in the beginning of the year, and they found themselves in a place that just wasn't safe. It was too crowded or whatever. They needed housing. So that was one category. The other category were investors, young people in particular, who said, I see an opportunity to get my apologies. I see an opportunity to get into the market where prices are a little bit soft. And so they jumped on it and they expected a discount. Most people simply withdrew their homes from the market, particularly as price levels went up. We know as the value of homes go up, typically incomes go up with them. Typically people the average age of buyers go up as we get into more expensive property, and people have the means and the capability to simply say, I don't need to transact right now. Why would I list my home for sale when the government's telling me to shelter at home? I'll just wait. And so you pull those transactions out. The ones that are in market are, call it distress sales. So we did see prices drop in the GTA, for example. Home prices they looked like they were down about 9% in the month of April. If we peel back the covers and we look same property, and we don't just look at the overall value of real estate and realize that luxury homes, for example, very few of them were selling, the actual value of properties fell about 5%. So we look to May across the entire country, and your trading area is bucking this trend, just as it has in recent years. The demand is higher, the supply is lower, so prices are higher, as Mike showed. But overall across Canada, home prices were down about 2.5% in the month of May. So they're coming back, but again, remember how average home prices are calculated. We take the total value of homes sold, like you've got $1 million home, $1 million home, and 5 $200,000 homes. So you take the whole overall value, that's 3 million, and you divide it by 7 homes. Well, if you drop out those $2 million homes, it makes it look like the average price fell more than it did. If you peel out the fact that in May, there weren't very many luxury homes selling across the country, or they were just starting to get back in the market, home prices were actually flat across Canada. So same property to same property, home prices were flat. And in markets where demand was outstripping supply, like your trading area, like right around the Golden Horseshoe, home prices actually started to ease ahead again in the low single digits. But for young people who are looking to get in the market, for example, first-time home buyers, represented a huge opportunity, because at this stage, my guess is we would have been at plus 15% year over year in terms of home prices in your area in Toronto. And instead we see maybe in April, May, flat to down a few percentage. So there could be up to a 20% affordability improvement over what it could have been. So it's not surprising that the number one driver of home transactions happen to be first-time home buyers during this time. All right, wrap up. A couple of interesting data points from elsewhere other than just the transactions. One is our sister company, Genworth, which is the largest private mortgage insurance company in the country, did a study on buying attitudes in February with Environics, one of the biggest research firms in the country. And then they discovered that that data wasn't that useful because it was done in February. So they went back into March and May. So we have this fascinating February versus May indicator of home buying intentions or home selling intentions that no one else has in the market. So it's very interesting data. It's worth going on to the Genworth Canada site and checking out the information. Couple of data points from that. One, people's buying intentions in the overall market or trading intentions, buying and selling, have not changed. So it was right down to the decimal point, the same before and after the transaction. They've shifted around a little bit. There's a slight increase in people who want to buy in the short term and a slight decrease in people who want to buy in the 12 to 24 month range. Why would that be? People feel that there's a short-term opportunity in the market. So it's pulling ahead some transactions. And remember that opportunity, as Mike said, the opportunity is both the sticker price of the home, but also the carrying cost of the home, because interest rates have never and will never be lower. So that's the first indicator. The other thing I found fascinating was a material. The biggest leap in the entire study was in the intention of people to purchase a home with less than 20% down. So what does that say? And it was over 20% increase in this population of people. It says young buyers, first-time home buyers, see a unique opportunity and they want to get into this marketplace. So that interesting stuff from Genworth. From LePage.ca. So LePage.ca is the country's largest real estate listings website operated by a real estate company. The largest website is Realtor.ca, which the overall industry, including LePage, operates. But when you get down to a real estate company putting listings, all the listings in the industry, not just LePage listings, but managed by a real estate company, LePage.ca is by far the most visited. If you go back to the beginning of April, the volume of visits on LePage.ca, and millions of people visit LePage.ca, was down 30%, which was quite year over year, down 30%. Quite disheartening, because I thought, well, people are locked at home, but maybe they'll still, kick around in a virtual way and look at homes. But no, they just weren't in the mood. Well, by the time May rolled around, they were starting to climb and climb till when we got to the May long weekend, we were 40% higher than 2019. And for the entire month of May, across Canada, visits on the country's most popular website were up 38% year over year. That is indicative of a huge interest in buying real estate, because people fundamentally feel the strength of the Canadian economy is still there, and they feel there's a unique opportunity to invest in real property at this time. And the last thing I'll touch on is the generational trends that Mike referred to, and how it's causing a shift in where people live. And this is of particular interest, and I've done numerous interviews in the last few weeks about this, because the media, urban planners, economists are fascinated with the question, now that people realize they can work remotely, will they live remotely? Will they change their living habits? Will they live in a place that's different than they would have lived before? What they're forgetting to ask, and the real fundamental question, is where were people going before this all happened? What were the trends that were pushing people into different regions of North America, of Canada before? And there was two big trends that were impacting trading areas like yours. One is the retirement of baby boomers. By our research released in 2019, 5,000 baby boomers are retiring every week. And many of them are saying, my kids aren't at home anymore. I'm an empty nester. I'm semi-retired or retired, and I really don't need this home, say in Legacy, Toronto anymore. The opportunity cost of holding onto it is too high, and I want a little bit less frenetic lifestyle. So they're moving to what we've coined the exurbs. So you've got urban living, suburban living, and then exurban living, which is just outside of our major metropolitan areas, an uncomfortable commute, but still a commute if you want to come in to watch a hockey game or see a play or something like that. Housing tends to be cheaper, and lifestyles tend to be more relaxed. Well, guess what? We have pressure from another group, which is the millennials. Millennials are the largest group of Canadians in history. There are more millennials, which are aged in the, call it early 20s to about 35, 36 years old right now. That group of people represents the largest group of Canadians in history, bigger than baby boomers. And those older millennials are starting to leave their trendy apartments and condos in the heart of big cities and looking to suburbs. And many of them, even before the pandemic, were in knowledge worker jobs where they could work remotely, say programmers or someone who applied their craft over networks. They could live in our semi-urban, ex-urban centers, and they were putting pressure on home prices outside of areas like Toronto, along with the baby boomers. So that trend was well underway. And if anything, it's going to be accelerated by the COVID-19 crisis and the learnings we've had about the changing nature of work. Now, the good news there for the economy overall is that we had severe housing shortages in our big cities. So any relief valve, any migration of people out of places where we have severe shortages to places where we just have shortages actually will even out prices, keep a lid on home price inflation, and help us manage the housing shortage, which I believe will be the biggest social problem of the next 10 to 15 years. And with that, Mike, I'm going to turn things back to you.
Awesome. That was awesome, Phil. Thank you so much. We did have a couple questions come in here. Just because we're running a little bit short on time, I'm going to ask you one of them, Phil, if that's okay, and then we're gonna move on to Shauna here. So the question was, does Phil believe the appetite for lenders, banks primarily, to finance home and multifamily properties changing or tightening due to COVID?
Yeah, in any situation where the chance of foreclosure, of people not meeting their commitments to a mortgage provider, a bank, rises, you see a tightening of lending standards. Most of it's pretty quiet. It's in the way they do appraisals in-house, and they just turn the crank up a little bit. But banks are businesses, just like any other business. And the main thing they're focused on right now is market share and a return to profitability. It was hard on them, just like it was hard on LePage and businesses right across the country. We took 10 weeks of the busiest time in our economy completely out of play. You know, I'll call it 2/3 of it out of play. And now people are scrambling to meet the demand. So I believe anybody who qualifies, and this is really good news for our system in Canada. We had the lowest default rate on mortgages, foreclosure rate, people not meeting their commitments in the world coming into this crisis. At less than 1/4% of mortgages went into default. It was 0.24, and it was historically low in Canada. So we were in a great position where we're started. Will that rise? Yes, it will rise. But the fact that the Department of Finance and the major lenders in the country got together and allowed people to defer mortgage payments for up to 6 months has been hugely valuable. And I've been really encouraged by the relatively small number of people that have had to do this. And it's about 11% right now of mortgages have asked for a deferral. And so we believe that while there will be an uptick in the default rate, it'll be minor. It'll probably stay under 1%, still just a fraction of what the United States has in pre-COVID times. And that drive for market share in business will allow people that are working and that have reasonable credit to get a mortgage.
Awesome. That was awesome. Thanks so much, Phil. That's all the time we have for questions right now, but we are going to reach out to any other questions that have come in personally after this, and we will get those answered for you. So thank you so much, Phil. And yeah, we are now going to move on to Shauna, who is going to take us through some case studies, and then she has an investment opportunity that she's going to present for us. So Shauna, take it away.
All righty. Thank you, Spencer. It's so great to see so many familiar names here today. I normally say faces, but it's virtual, so this is new for us as well. So it's great to see so many familiar names. I'm going to walk you guys through a couple of examples that our clients have recently purchased and are having great success with despite purchasing during this COVID environment. Okay. So I'm going to start off here with a great duplex located in downtown Brantford. It's full of character, this home. It's a side-by-side duplex, which typically is also slightly more desirable as well, just given side-by-side instead of one over the other for noise reasons and whatnot. It has 2 hydro meters, 2 gas meters, 2 water meters, and it's 2 two-bedroom units as well, which traditionally has the lowest vacancy rate. Okay, also plenty of parking here as well. So this property actually was listed beginning of April, which you may remember from Phil's speech and from Mike's as well. This was actually more or less the bottom in terms of showing activity. So it was listed April 2nd, at which point showings were down almost 68%, which was the lowest mark that we hit. So needless to say, these sellers may not have been getting the traction that they may have originally anticipated when they listed this home. So our strategy upon viewing this home, we knew right away we wanted to negotiate a longer closing date. And the reason for that was that we knew the resale market was slowing down from a showing standpoint, but we didn't really know what to expect from a tenant standpoint. So the property itself was vacant, and to minimize any carrying costs, we didn't want to close on it and not being able to find tenants for months on end, right? So we wanted to negotiate a longer closing. In fact, we targeted roughly a 90-day closing just so we can mitigate any risk in the tenant market. Tied into that, we also wanted to work in a clause that allowed us to show the property to prospective tenants in the meantime. And what this does is it allows us the potential to line up your lease start date with your closing date. So again, you can close on this property without any empty months and you having to carry this property. So what ended up happening after some negotiations with the seller, we came to an accepted offer, which ended up being 96% of their asking price. So it is important to note too, the city's average list to sales ratio was hovering just shy of 99% at the time, 98.6%. So got it for a great deal. We went through, fulfilled our conditions, and then upon firming up, we immediately posted our rental ad for rent. Well, weren't we blown away? At this point, we got over 500 views just within 24 hours of these rental ads. And because we had that clause in there that allowed us to show the property in the meantime, we were able to do so. And as a result, ended up getting 6 applications for this property within a 2-week time span. So huge success finding tenants despite the COVID environment we were in. Ended up getting 2 phenomenal tenants that were able to actually move in earlier than our initial closing date that we negotiated, and ended up advancing the closing date to accommodate that. So great success, prime example of the market conditions and how much it varies even from the resale market to the tenant pool market. So at the time, this is what we were forecasting the property to perform as. We were budgeting, I call it a worst case scenario. We're very conservative. So we were running the numbers based on full asking price, which at the time was $401,000. We were forecasting rents to be $2,900 for the entire building plus hydro, because at the time they were only advertising 2 hydro meters, which we later find out was different. With those numbers, it still gave us a net monthly cash flow of $904 a month and a very healthy ROI at 43.29%, which for a turnkey property was performing great. After the negotiations, we ended up securing it for $385, and we were able to rent the unit for $150 more than we anticipated. And because we later found out there was also the 2 gas meters, 2 water meters, we were able to lower our expenses. So we were increasing our income, lowering our expenses, which gave us a huge jump in our net monthly cash flow, an increase of almost 45% versus what we expected. And then of course our ROI follows, almost 50% return in the first year for a turnkey investment. So congratulations to our clients on this property, and I think this is going to be a phenomenal addition to their portfolio. Switching gears a little bit, our second success story is actually a rehab project that is going to be in the works very shortly. It's a large century home. It's located in what I would consider an A+ neighborhood in Welland. It's was currently 2 units. And again, this property was fully vacant, which is important, especially for a rehab property, because it allows you to go in, do your renovations without disrupting any tenants. The zoning for this property allows for multiple dwellings, and given the size of this property and the lot size and the parking and all these other variables, the plan is to convert into 4 units. The layout caters very nicely to that. But with every rehab, there's always risk, right? So I always recommend having a plan B should plan A not pan out as planned. So plan A, convert this once 2 units into 4 units. Plan B would be to convert it into 3 units. Believe it or not, the financials work out very similar. And the reason for that is with 4 units, the city is going to have a list of more specific requirements that you're going to have to meet. And there's a larger renovation expense as well, right? So you have to worry about the time, the carrying cost while you're renovating, plus the cost to do that 4th unit in the first place. So although your after repair value may be higher, your expenses are also higher. Whereas with 3 units, it could be a faster renovation. You can get tenants in there faster. You can start cash flowing faster. Your carrying costs are reduced. And the renovation expense is also reduced as well, right? You have 1 less unit to worry about. So great plan A, great plan B. Either way, it was looking like a win-win situation. It's a great property with plenty of private parking as well. So our strategy on this one actually was listed at the end of April. So at this point, showings were down about 37%. So we were starting to see a trend upwards. We were noticing that more and more showings were taking place. The market was starting to gain some traction. So much so that we actually found ourselves in competition on this property the first time around. So we unfortunately lost out on it. The seller accepted a higher priced offer. A few days later, we get wind that that offer is now going to be releasing. So strategy came into play here because we acted fast to get our offer back on the table before that property went back on MLS. Because once that happens, we found ourselves in competition the first time. We didn't want that to happen a second time. Okay, so we acted fast, got our offer put together. We were able to receive a counter offer back from the seller, basically removing our conditions provided we get our price. So we went back, took a closer look. We were comfortable going in firm to get our price. And in the meantime, while that property made its way back to MLS, of course, multiple offers came in. But the beauty of this situation was we had all the power. As the buyer, the ball was in our court. So the seller countered us. Even if another buyer offered them $1 million, they couldn't do anything. And that was part of our strategy all along by submitting our offer fast. So in the end, great success. We accepted the counter offer. We found out that it was the agreed upon price was $20,000 less than the previously accepted offer and $14,000 under the asking price, which for being in competition arguably twice is a huge win. So the financials on this property are projected to perform as follows. So purchase price of $365,000. Renovations are quoted at about $280,000 for their plan A, which is 4 units. Given the location, recently sold comparables in the area, a very conservative after repair value is going to be forecasted about $650,000, giving the total year 1 ROI of about 54%. Now keep in mind, that's just forced appreciation alone. When analyzing investment properties, we call them the 4 fundamentals, right? You have your forced appreciation, your passive appreciation, which is your market appreciation essentially, your cash flow, and then your principal recapture, how much of your mortgage principal gets paid down by your rent every month, right? So this is just one component of what comprises the total ROI. Okay, so great example, quick timing, and a great addition to our client's portfolio on this one, and we wish them the best of luck. Very excited to see some after photos on this one. I'm just going to pause here quickly and check in with Spencer. Is there any questions at all about either of those case studies?
Not that I see. Did anyone have a question at all?
If not, we can reach out after the fact as well, if anything comes to mind as I'm chatting here. So I'm going to move on here to just keep watching time, our opportunity. Okay, so I'm going to talk to you guys a little bit about a fantastic opportunity on the market for you guys to take action on. It's actually a turnkey, purpose-built 6-unit building in St. Catharines. It's located on Glen Ridge. So for those of you familiar with St. Catharines, know that this is a phenomenal area, very close to Brock University. So as a result, this neighborhood does have a large student rental population. And historically, this building has been rented to students with no vacancies. However, student rentals are proving to be one of the more riskier investment mediums given the time that we're in. And that's largely because a lot of the universities have moved, at least their fall semester, to an online platform. Okay, so at this point, you're probably wondering, why the heck is Shauna showing me this if there's no students to rent to? Well, notice I said historically. The beauty of this neighborhood and this property is you're in a neighborhood with such a diverse tenant demographic that you don't have to rent to students. And in fact, that's exactly what the current owner has done. They were able to seamlessly transition from being a student rental to a regular traditional rental. 4 of the 6 units in there right now are currently rented to families. So on the surface, this property may look risky, and to a lot of investors, they may brush it off and move on to the next one. But if you're working with a realtor or you're familiar with the area and you know this neighborhood, you know that you don't have to target students should you not want to. And I love areas like this for that reason, because it maximizes your tenant pool, which as a result should lower your vacancy. Not only that, but your exit strategy, right? When you go to sell this property down the road, if you come across an investor that wants a student rental, well, here it is. Or if you come across a buyer that wants just a great purpose-built 6-unit building, here it is, right? So you're maximizing your tenant pool, you're maximizing your buyer market for your exit strategy. It's a win-win all around. Nonetheless, I digress. Beyond that, the building itself. So you have a bus stop directly right out front. So one side of the street will take you to Brock University. The other side of the street will take you right downtown St. Catharines. You're super central. It does have coin-operated laundry in the building, plenty of parking in the back, and we are priced at $1.398 for this one as well. Location-wise, you're also walking distance to the Penn Center in St. Catharines. Great highway access. So again, we talked about renting to families or the younger working professionals. If they're commuting in and out of the city, this location is a dream for them. Again, what I would call located in an A-plus neighborhood. In fact, the average income in this area, household income, is roughly about $90,000 annually, whereas the city's average is just north of 83,000. I think it's 83,600. So you're in a pocket within St. Catharines that has a higher than average household income, lots of white collar jobs. And again, you have that flexible tenant demographic, whether you want students or traditional. So let's take a look into the numbers and how is this property performing. So the unit mix that's in here currently, you have 2 2-bedroom units and 4 3-bedroom units. Okay, so the 2 bedrooms are rented at $1,100 each, and then you have a range anywhere from $1,590 to $1,650 for the remaining units, giving us a total rental income monthly of $8,680, and that's right at the top there. Now we also want to factor in our vacancy rate. So we always traditionally use a 3% vacancy rate for our region. In fact, the 2-bedroom vacancy rate in St. Catharines is hovering around 2%. So we do err on the side of caution, even with the vacancy rate. Okay, so once we take that off of our monthly income, that gives us a gross operating income of roughly $8,400. Okay. Beyond that, we have our expenses on the building. So taxes are about $6,400 annually. We have our estimated insurance budget. Utilities you see on here is, so 4 of the units pay their own hydro, 2 are all inclusive, and then plus on top of that, you would have your common area utilities. Okay, so that's what comprises that utility number there. We also work in a 3% repairs and maintenance budget and a 7% property management fee as well. So should you choose to go that route, it's already factored into the expenses for you, making this truly as turnkey as possible. Okay, so we have our income, we have our expenses, take those and we're left with $6,400 a month, just over, $6,401. On top of that, we have to pay our mortgage. Okay, so because you are a 6-unit building, you're going to likely going to be into the commercial lending world, which means that the lender may require a higher down payment and they may require a higher interest rate as well. Okay, so keep those variables in mind. And that's how we calculated our debt service. So we used a 30% down payment to be safe with a 4% interest rate over 25 years. With that, again, at full asking price, worst case scenario, we're looking at a monthly payment of $51.48 a month. Okay, so we had our net operating income, which was our income minus our expenses, minus our mortgage payment. We are still left with $1,253 net monthly cash flow. Okay, that is cash in your pocket every month. Now, the largest barrier to entry on this building is going to be your acquisition costs, largely because of the higher down payment. Okay, so you're going to be, the bulk of it is going to comprise your down payment. With all of that, with our 4 fundamentals, the ROI still gives us a return of over 24%, which for a commercial building is very, very strong. Looking in the bottom right hand of your screen here, you'll see cap rate, 5.49%. Lots of times, believe it or not, we see these commercial purpose-built buildings sell anywhere from 3 to 4% cap rate. So here we have a 5.5, very strong performance. So overall, it's a very turnkey auction. You have many tenant profiles, A+ location, and you're absolutely central to everything. Great addition, or great opportunity, sorry, to add to your portfolio. And I'm just watching the time, so I'm gonna pause here. If there's any questions, make sure you type them in the question box here, and we will gladly get those answered for you. Is there anything I don't think I see?
I'm just logging in there, Shauna. Thank you very much. Taking over. You did a great job. There were a few questions there. We'll get back to you. I think you answered most of them as you ran through the numbers. There was one question. Somebody was wondering about a time that something went wrong. I'm going to call you directly, share all kinds of stories. Of course, we try and mitigate that, and that's where our experiences come into play. So you know who I'm speaking to. I'll give you a call. It gives me a chance to call a past client and a friend. So I'm going to kind of wrap us up here in closing. And I love this slide. I've shared it before. You can go throughout history and find a reason almost every year not to invest. I don't want to invest my money now because, well, in 1934 was the Great Depression, and then you had the Korean War, for example, in 1950. Of course, JFK was assassinated in 1963. Oil prices rised in the late 70s, early 80s. Y2K, that was a reason. We're supposed to be devastated. And certainly here we're sitting at, some COVID in 2020. So I can look and go through history and find reasons not to take action, but we take a very advisory role approach, a very conservative approach, as Shauna talked about, and really look at the basics and the fundamentals of how properties perform. I'm going to share, if you haven't read the book From Good to Great by Jim Collins, it's a great book. It's one of my favorite. And in that book, one of the things that Jim Collins talks about is mindset of people, or the 2 types of people. And he goes on to kind of define, it's an analogy that I'm sure he's borrowed up from elsewhere, but just indicates that there are 2 types of people. There are people that act like a fox, those that are unfocused, easily distracted. They spend a lot of time and energy, running around and conniving and sneaking and figuring out how he's going to get the hedgehog. A lot of energy and focus on, how am I going to plot to get this hedgehog? And then there's a hedgehog that focuses on one single idea. He's not distracted. All he has to do every time the fox tries to get him is just roll up into a ball and let his quills protect himself. So in times like this, try to be a hedgehog. Focus on what you know, whether it's the fundamentals or taking action. And many of you are already on one of our mechanisms, but how can you take action? I've got 2 mechanisms that we often use to get started as kind of an educational component. We have our deal of the week. Each week, Shauna's prepares and presents for us and bets and puts out what we perceive as the best investment opportunity in 3 marketplaces that we serve: Brantford, Hamilton, and St. Catharines. So 3 times a week, you'll get an email of what we perceive. We vetted the property, we run the numbers. There's no obligation. I'm going to send out a link, or the team's going to send out a link after this as to how to subscribe to ensure that you're getting our deal of the week. It's a very informative, passive approach to receiving great opportunities that have already been vetted. The second, and nobody's received this because it's taken a lot of work and we've just finalized it, we've got our investors report. And the team's taken a lot of time and resources to compile all of our regions within kind of the Hamilton area, average prices, vacancy rates, average rental rates, the months of inventory, tons and tons and tons of great data in this investors report. So taking action is going to be simple. You don't have to do anything. We're going to follow up with all the registrants, all of our attendees that joined us today, giving you a link to both of these resources, and hopefully we can help educate you, serve, be here to assist for any questions and any assistance that you guys need in any of your real estate needs, whether it's a new home or resale home, or of course this has been focused a little bit around the investor component. So to keep time front of mind, we run a little bit over time, but again, I'd like to thank a huge shout out to Phil Soper. You know, he was, I believe he was at his cottage sharing with us, showing how you can work remotely, but his time's extremely valuable, and I know he delivered a ton of useful information. So I'm grateful for that. Grateful for you guys all. We had at one point almost 100 people log in today, so grateful for your participation. Thank you for your continued support, all of you. We're here to help. And we look forward to our next session where hopefully we can see one another face to face. So thanks for logging in today, and we hope you all have a very happy and safe summer. Okay, talk soon. Take care.